Well, I think one of the most important things he stressed on was the fact that in terms of our medium-term outlook, the whole economy is muted. So what that means is that we need to now begin to relook at our policy, both our monetary policy and fiscal policy, to see how we can stimulate growth because our economy is still not growing over 3%, which is the rate of population growth. So there have been some hardcore analytics here which we could use to develop a policy for sustained growth and development.
All right, then, but there's a lot, they also mentioned that, bold reforms are needed to, that could boost the confidence for investment. When you look at how we've been trying to get investment into the country over time, though, do you think we've performed below par?
Of course we have, and I think one of the most important things we need to take a look at, which they've looked at, is the exchange rate. We have a very good exchange rate window, which is called NAFEX. If we eliminate all these other exchange rate windows and have one single exchange rate window, we have about $25 billion that comes in from the diaspora. We have another $15 billion that comes in from portfolio investors. If all this money, including what the government brings in, is going through one window, I have no doubt that the Naira will be trading at nothing less than 220 Naira to 230 Naira, that band. And you have an open exchange, flexible exchange rate system that people have confidence in, and that's the key word. If you put confidence in the foreign exchange market, then remove all the distortions within also the central bank lending, all kinds of intervention loans, which is causing distortions. Have one single interest rate window, have one single foreign exchange window. You stabilize those rates and you inspire confidence. Clearly, the government is spending close to 65% of its revenues to service debt. So what that means is that government does not have the funding to be able to create the stimulus the economy needs. So that means that also the infrastructure deficit he talked about, in terms of trying to 35% of our GDP, private sector can fill that gap if there's confidence in the system. FDI levels are at all-time low. Even the portfolio investors also at time low, and the stock market is not doing very well. So that's the confidence we need to bring back, has to do with the fact that if the government can look at this report, then they can redesign new policies, both on the fiscal side and the monetary side, to be able to spur confidence and be able to attract private sector investment. Because clearly now, it's private sector investment that is going to drive the growth of this economy going forward, because government can do it. He also mentioned something else about our ability to mobilize revenue. It's like at about 3% of GDP, the lowest in the world. So it's going to take time for government to ramp up its activities of tax reform. What the FIRS is doing right now, that's going to take a while. So government really needs to be able to position this economy for the private sector to bring in investments that will spur growth. Because if our economy is not growing at least 5–6% per annum, then, as I said, the medium-term outlook will remain muted.
All right, then, beyond that, now let's look at his views on monetary policy. He was of the opinion that the tightening cycle we've seen so far since 2016 has kind of been appropriate and can kind of help the inflation.
Yes, I think up to an extent. But don't forget that some of these indicators are leading indicators and lagging indicators. Yes, inflation was on the way down, and we agree that, yes, they had tightened monetary policy to tame inflation so that we don't become like a Venezuela. Very important, so that the fundamentals are right. But at a point in time last year, the government, the central bank, in my own opinion, missed a point whereby when we realized that the trajectory on inflation was actually considered downwards, at that point in time, they should have cut rates to be able to spur growth. So I think we missed that opportunity at that point in time. And right now, again, we need to go back to the drawing board to press the reset button to be able to come out with new policies for fiscal policies, new policies for monetary policies, and of course, we also have to take a look at our trade and investment policies to see how we can tweak that to be able to restore confidence that will drive private sector investment that will grow this economy.
All right, then he also mentioned something interesting in the report, though, although I didn't get to that conversation with him here during the interview. But in the report, the IMF kind of alluded to the fact that phasing out subsidies, and improving on the social safety nets would help reduce the poverty gap, in Nigeria. I'd like you to speak to that point.
Very important. I mean, if you take a look at the poverty situation in Nigeria now, Nigeria is now the global poverty capital. And that is because your economy is not growing as fast as your population. So you have a negative in terms of that. If your population is growing at 3% and you're looking at 2% growth, there's a shortfall, especially coming out of that recession. So our growth trajectory is quite muted, which is the word they've used, the key word there. So we don't have the stimulus that is stimulating growth. If your economy is growing at 5%, 6%, then it's growing higher than the rate of population growth, and then you're moving people out of poverty. The subsidies are only killing the economy because not everybody benefits from that subsidy. And that subsidy is also money that government can use towards debt service. It's a debt service at 65% of revenues is not sustainable. So you need to remove subsidies so that you can have more money to be able to manage your debt profile and to be able to have money to be able to create capital investments that will stimulate growth.
All right, then, on the financing the budget and how the government's debt strategy is looking going forward, what would you say on that point?
Well, I think he made a valid point that it's cheaper right now to borrow from abroad and also take a look at concessionary loans. So it's something that the government has been trying to do to restructure their portfolio to be able to put a significant percentage of their portfolio into foreign debt. You've seen that in the last 3 years, the debt profile in Naira terms has actually doubled from about close to 11 trillion to about 22 trillion Naira. And that's pretty significant in like 3 years, the rate of that growth. So significant portion of that debt is local debt, which is more expensive, especially since treasury bills at a point in time were trading at 18%. So all these sort of monetary and fiscal distortions also has a cost to government and also cost to private sector. And as you've seen from the figures from this quarter, for the first time in a long time, most of the credit is going towards the government as opposed to private sector. So the private sector is clearly crowding out the public sector is clearly crowding out the private sector. So if the private sector is not growing, then you'll find the fact that unemployment will continue to remain at 25, 30%, and the sort of growth that we need to get this economy out of the way, we will not achieve that growth. So the key issue here now is restoring confidence to the economy by removing the distortions in the foreign exchange system with the subsidies and also with interest rates.
All right, then. I just wanted to speak to another point around the banks that he mentioned. He was talking about the state of the financial sector in Nigeria. Do you agree with this point?
Yes, very important. We have about 5% of the banking system, so banks who are not capitalized, that is actually weighing down the whole system. So those banks, they're not, systemically, they're not very important. They don't pose a systemic risk to the system. But in terms of the whole overall ratios, those banks are actually weighing down the rest of the other banks. So it's important that we look at recapitalizing all the banks at a point in time. And a lot of the banks are coming out of a lot of challenges with their portfolios in terms of using a lot of more dollar loans in the oil and gas sector. And they clean that up and they're coming around with that. So the financial system is robust, is healthy, but there's a small percentage of that they really need to do. So they could take those banks out, or they could get them to merge with other banks. There are many ways you can resolve that. And I think if the central bank has the will to do that, that is something that's a quick win. It's a low-hanging fruit. All
right, then finally, before I let you go, there's the issue around Gambia ratifying on the Africa Free Trade Continental Agreement and what it means for Nigeria. So now we have 22 countries that have ratified. Ethiopia was the 21st country, and now we're seeing Gambia's parliament yesterday approving that process. Well, what does this mean for trade for Nigeria?
Well, for me, what that means is that, ironically, is that Nigeria has lost its leadership on the continent. And a sort of agreement of this nature, Nigeria should be seen to be taking the lead because a lot of Nigerian conglomerates have the productive capacity to be able to develop and serve the continent. Our oil and gas capacity in terms of petrochemicals, refineries, and even gas monetization programs could impact not only Nigeria, but we have a larger market not only within West Africa, but within Sub-Saharan Africa and the whole continent as a whole. If we do not begin to take the lead in all these things, countries like Ethiopia, Rwanda, who do not have the size of our economies, are taking and championing these leads. And it's important that we look at this, understand it properly, and take a rightful position as the giant of Africa and the largest economy on the continent to drive this process.